Welcome to the DLR channel. The letters in the channel DLR stand for dividends, leaps, and retirement. I have started this channel to educate myself as I am in early 50s and want to build a nest egg that outlives me. I hope you will find some takeaways to start your own research. Please note that I'm not providing any financial or investment advice. Everyone needs to do their own research and or talk to their personal financial advisors. S&P 500 is often taken as proxy to the US stock market, along with the Dow Industrials and the Nasdaq. I have chosen to stick with S&P 500 though for this study. As you see on the screen, and this is from the website microtrends.net, as you can see from the screen, a lot of data is available for S&P going as far back as 1930s. And what you notice is every decade, at least 1 or 2 years, where S&P or in general the market suffers a downtrend. Sometimes it's quite steep, sometimes it's small, but you see a like in early 1930s or more recent, like early 2000s and the 2008 crash. So what do we do? How do we, or how do I reduce the downturn? How do I protect myself and my investments? So for that reason, I've been doing some research and I'm trying to share this as a way to keep checks and balances on myself too. So what do you see, for example, if I retired in early 2000, and then whatever my nest egg would have been at that time would have dwindled 10.4%, 10.14% in 2000, and negative 13%, and the next year 2001, and negative 23% in 2002. That's a significant, that would have significant impact on my nest egg. So I'm trying to develop a strategy where the loss is reduced every year. And this particular strategy will also cap my profits if the market goes up, but it will reduce my drawdown if market goes down. So now that's why I'm using stocks that give dividends. So D stands for dividends in the DLR portfolio. The letter L stands for leaps. Leaps are one type of call options. And if you don't know what options are, I'll make another video to explain those. Leap call options, I'm using leap call options to get some more income based on my stocks. So since I'm sticking with S&P 500, I want to spread my hypothetical dollars. I'm starting with $500,000 in my hypothetical portfolio, and I'm spreading that $500,000 as shown here in the Excel sheet. I'm distributing the $500,000 into the 11 S&P 500 sectors. The S&P 500 sectors are shown in this Excel sheet here. Healthcare, financials, energy, utilities, information technology, consumer discretionary, industrials, materials, real estate, consumer staples, and communication services. So just let's go back to the websites. And this particular website is ETF.com. And this website shows the weight of different sectors that comprise of the S&P 500 index. So as you see on the screen, IT has a heavy weight, whereas utilities have only 2.8% weight. So there are mutual funds that mirror the S&P 500. I'm not doing that. It's my own hypothetical portfolio. So instead of spreading my $500,000 hypothetical dollars into this particular ratio, I'm dividing them equally. So each sector gets equal weight. And I have picked only one stock from each of those sectors. These are the stocks that I picked from each of the sectors. AbbVie, Aflac, Chevron, this is Consolidated Edison, I believe, IBM, McDonald's, 3M, New Car Mining, O is the real estate, Realty Income, Procter & Gamble, and AT&T. So, I mean, this is my picks. You may decide to go with, you do your own research, and you may pick another different stocks. However, anybody wants to do, it's up to them. This is mine. So $500,000 distributing equally in 11 stocks means it's 45,000, about $45,000 into each stock. So this is hypothetical trading. So I'm just going with the price, as my starting point. I'm assuming that I bought all the stocks at the close of December 31st, 2021. So this is the prices that you see of each of the stocks at the close of the year 2021. So for the amount invested, I get so many shares. That's the math there. You have so much money, and then that's the price of the stock. So you ended up with so many shares now of MV. So I did mention that all the stocks give dividends. So D stands for dividends. So all the stocks have been giving dividends for a number of decades. So, that's why I picked the stocks. And that's another thing. You can find that online, dividend aristocrats and dividend kings. If you type them, you will find a lot of information on them. So I went to one of those websites and selected these stocks to put into this hypothetical portfolio. And I also mentioned I'm using something called leaps. So leaps one can buy or sell. So basically, leaps are call options. So I'm a call option will have two parties, a buyer and a seller. I'm taking the part of the seller, playing the role of the seller. So I'm selling 3 call options to someone who wants to buy. So someone would have bought this in a hypothetical trading portfolio. So now, why do I sell 3 call options? So the way these things work is, if I have 100 shares, I can sell 1 call option. Since I have more than 300 shares, but less than 400 shares of AbbVie, I can sell only 3 call options at most. So I'm selling 3 call options. So now the buyer, these call options will have 3 things. They'll have an expiry. So this call option expires January 20, 2023. So 1 year from now. And the target price that I have chosen to sell this call option is 150. So there are 3 things, the premium that I get for selling this. Basically, I'm giving a right to the buyer to buy this particular stock, AbbVie, from me on or before January 20, 2023 at 150. Okay. So even if the stock goes to $200, I will be obligated to sell the stock to the buyer of my call option at 150 on or before the expiry date, which is January 20, 2023. For giving him the right, he is paying me some premium. You see the premium is here. This premium is quoted in, it's at that time, it's based on that date, December 31st, 2021. The premium quoted on that date, this is the midpoint of the bid and ask spread. So that premium is per share. Since I'm selling him 3 calls and each call is worth 100 shares, I will get a premium income of $1,869. And then I'll retain the stock if it is not called away. If the buyer is not exercising the right, I'll hold the shares in my portfolio till the date. Now, so for that, I get a quarterly dividend from AbbVie, the company. And this is the total dividend. Let's say I am holding this stock, AbbVie shares, till this date, the expiration date. I'll get 4 quarterly dividends, and that is the total dividend I get for the 335 shares. Now, let's say comes January 2023, and the stock is at $155 per share. So then the person who I sold this call to, whosoever that person may be, I don't know, whosoever that person can call away my shares at 150. He made $5 profit. I mean, he, whatever his numbers are, he has a right to buy this AbbVie shares, 300 shares from me at 150, and the price is 155 in a hypothetical situation. So my shares will be sold. 300 shares will be sold. So then this is the net profit I'll have on January 2023 if the stock price of AbbVie is above 150. That's the thing. Okay. So how did I get this? Look at this math here. So this is the call away profit. That math is there. You can stop the video and pause the video and check this math. So 300 shares are being called away. So the difference between the strike price, that's where the stock is sold, 150, I'm selling the shares to the buyer of the leap. And then this is my cost price, 135.40. So the difference between those two is my net profit times 300 shares. And then I also get to keep the premium income that I received from selling the call, which is 1869, and also the dividends. So all those things is my net profit. If the price of AbbVie is above 150, that's important. If the price is less than 150, then the buyer of the call option will not buy the stock at 150, right? So then he will lose all the premium that he paid to me. He lose 1869, but I get to keep that. Even if the stock is like 149.99, it's not 150. So this premium will erode every day. Eventually, if the stock price does not reach or cross 150, the premium erodes. I keep all the 300 shares and this extra shares that I have, that $35.71 extra shares. So that's the thing. So call away profit is this. And if I decide to sell the remaining 35.71 shares, also at 150, just close the books on that trade, then this is my net total profit. And in the other situation, if the stock does not reach 150, then I get to keep the shares, all the shares, I'll still have them with me, and I'll get to pocket the 1869 in premium income and the dividend income. So this will be my not called for profit. So let's say the market tanks and nothing happened, none of the stocks reach the target prices or the strike prices, and I get to keep all the shares of all this stocks, then my net profit at the end of the year will be this much, about $40,000 and 7.77%. So that will be my net profit, even if none of the stocks reaches the strike price. So I get to keep all the stocks, all the shares of all the stocks, and still make this handsome profit. Okay, so that's in a nutshell. I mean, there are all other scenarios. I want to keep the video short as it is my first video, and then maybe work on the future videos. I'll go into a bit more detail. And why did I pick these strike prices. These strike prices that I picked for each share have the 150 strike price. I'm selling a leap call with the strike price of 150. That means, and for AT&T, the strike price I chose was 27. So how did I come up with the strike prices? The strike prices are, you see, are close to column G, which is my target price. How did I get my target price? I chose 10%. So if you do this double click there, you see the target price is 10% more than the price I bought for. Okay. So why did I pick 10% as my target price? So for that, I did some research, and you see this data here, this data here. This is what different financial bigwigs are forecasting. So this is the data from FactSet. All the researchers called by FactSet in whatever the research that organization does, they're forecasting S&P 500 to increase by 9%. And Morgan Stanley, on the other hand, came up with a negative 6.9%. So they are expecting S&P to fall negative 6.9%. So I took the 10% as hoping that S&P 500 will increase 10% based on this number, say 9%, 9.6%, and then a bit above, and to come up with the nearest strike price. You cannot have strike prices like this. Strike prices have certain patterns by which they go by. So I picked those strike prices. So you see, even if the market falls negative 6.9% as predicted by Morgan Stanley, I'll still come out ahead by about 0.8% or something. So so that's it. So let me know and how I need to improve on this on my attempts. This is my first video anyway, and subscribe. So just we'll see where we go with this. And here I have a bit about data about in which months this different stocks give dividends. So you see that you do get dividends periodically. And if you are a retiree and you need to take money, this is my, all this is for me to take money, and that money should not, I should not outlive the money. So for this reason, I'm putting all this stuff here. So good luck if you want to follow the strategy, but you need to do your own research. This is mine. So see you later.